Welcome to our channel. Today, we're diving into one of the most dramatic events in recent financial history, the flash crash of May 6, 2010. This event sent shockwaves through the financial world and left traders and investors reeling. On May 6, 2010, at approximately 2:32 p.m. Eastern Time, the U.S. stock market experienced an unprecedented and rapid decline. Within minutes, major stock indices, including the Dow Jones Industrial Average, plummeted by about 1,000 points, or nearly 9%. This sudden drop wiped out nearly $1 trillion in market value, only for the market to recover most of those losses within the next 20 minutes. The event became known as the flash crash. To understand what happened, we need to look at the factors that contributed to this extraordinary event. The flash crash was the result of a perfect storm of market conditions, high-frequency trading, and a lack of liquidity. In the days leading up to the flash crash, there was significant market volatility due to concerns about the European debt crisis, particularly in Greece. Investors were already on edge, and the market was highly sensitive to any negative news. On the day of the flash crash, a large mutual fund company initiated a massive sell order of E-mini S&P 500 futures contracts. This sell order was executed using an algorithm designed to trade a specific number of contracts over a set period, regardless of price or market conditions. The algorithm did not take into account the market's liquidity, which was already thin due to the ongoing volatility. As the sell order was executed, it triggered a cascade of selling by other market participants, including high-frequency trading firms. These firms use complex algorithms to execute trades at lightning speed, often making thousands of trades per second. In this case, their algorithms detected the large sell order and began selling as well, exacerbating the downward pressure on the market. The rapid selling caused a severe lack of liquidity, meaning there were not enough buyers to match the sellers. This imbalance led to a dramatic drop in prices, as sellers were forced to accept lower and lower prices to execute their trades. The lack of liquidity was further compounded by the fact that many market makers, who provide liquidity by buying and selling securities, withdrew from the market due to the extreme volatility. As prices continued to fall, stop-loss orders were triggered. These are automatic orders placed by investors to sell a security when it reaches a certain price, intended to limit losses. The triggering of these stop-loss orders added to the selling pressure, creating a vicious cycle of declining prices and increased selling. Within minutes, the Dow Jones Industrial Average had dropped nearly 1,000 points. However, just as quickly as the market had fallen, it began to recover. High-frequency trading firms, which had initially contributed to the sell-off, began to buy back securities at the now significantly lower prices. This buying activity helped stabilize the market and led to a rapid recovery of most of the losses. In the aftermath of the flash crash, regulators and market participants scrambled to understand what had happened and how to prevent a similar event in the future. The Securities and Exchange Commission (SEC) and the Commodity Futures Trading Commission (CFTC) conducted a joint investigation and released a report detailing the events of that day. The report concluded that the flash crash was triggered by the large sell order from the mutual fund company, which set off a chain reaction of selling by high-frequency trading firms and other market participants. The lack of liquidity and the triggering of stop-loss orders further exacerbated the situation. In response to the flash crash, regulators implemented several measures to prevent a similar event from occurring. These measures included the introduction of circuit breakers, which temporarily halt trading in individual securities if their prices moved too rapidly within a short period. Additionally, new rules were put in place to improve market transparency and oversight of high-frequency trading. The flash crash of 2010 serves as a stark reminder of the potential risks and vulnerabilities in modern financial markets. It highlighted the need for robust risk management practices, improved market infrastructure, and effective regulatory oversight to ensure the stability and integrity of the financial system. What do you think about the flash crash? Let us know in the comments below. Don't forget to like,